David Rosenberg believes that the S&P 500 should be 1,000 points lower than it is today, and he's based his predictions on sluggish U.S. economic growth and overvalued equities. He believes that a reversion to the mean in U.S. stock prices could mean the market will fall by at least 20%. Rosenberg, who is the chief economist and strategist at Toronto-based Gluskin Sheff, said this is one of the strangest security market rallies of all time. That's because all asset classes have gone up, even ones that are inversely correlated. But he thinks that a breaking point is a year away. So let's take a look. During a strategic investment conference, Rosenberg showed investors an ominous picture. And starting out with this chart here, Rosenberg pointed out that only 9% of the time in history have U.S. stocks been so expensive. And this chart here is the cyclically adjusted price to earnings chart. And we've seen this and talked about it several times. And the current peak where we are at the far right of the chart is higher than any other point with the exception of the dot-com bust in 2000. Given that we're the second highest point, that 9% of the time must have been spent during that 2000 dot-com bust. Yet this still is a very ominous picture. We're quite high, and I would imagine that at some point we will revert back to the mean with the average far below where we are today. And then he showed this table here with gross domestic product growth figures in the last 9 bull rallies. And as you can see from the table reveals the trend where each subsequent bull rally in the last 70 years generated less GDP growth. Essentially, it means that we are paying more and more for less and less growth, which also means that all that quantitative easing over the last several years has diminishing returns. Another historically accurate indicator that predicts the end of bull cycles is household net worth share of personal disposable income. And as you can see the chart here, the last 2 peaks in this ratio almost perfectly coincided with the dot-com crash and the 2008 great financial crisis. Now, the ratio is at its highest level since 1975, which is another sign that maybe reversion is on its way. And again, the average is well below our current level. As another strong indicator that recession is around the corner, Rosenberg quoted the Federal Reserve Bank of San Francisco. He pointed out that having access to tons of research, they themselves admit that equity valuations are so stretched that there will be no returns in the next decade. And he says that the Federal Reserve Bank of San Francisco quotes that current valuation ratios for households and businesses are high relative to historical benchmarks. We find that the current price to earnings ratio predicts approximately 0 growth in real equity prices over the next 10 years. Stretched valuations are not the only problem for the stock market. Rosenberg thinks that the new Fed chair, Jerome Powell, marks the end of low interest rates, which will also add pressures to equities. Rosenberg thinks Powell won't cut interest rates, even if we get a 20% sell-off in the stock market. That's how determined Powell is to normalize interest rates. In other words, we're in the middle of the Fed tightening cycle. As history shows, a tightening cycle is almost always followed by a recession. The bottom line, all signs point to a recession, which Rosenberg predicts is again about a year away. As he suggests, de-risking your portfolio means raising cash and investing in asset classes that are not correlated to the stock market. And then this from Business Insider, and I'll just read to you from the chart. If credit peaked in January, yields peaking by September, and equities peaking before year end would be normal U.S. market sequencing. And this actually dovetails with regard to my previous video where both I and Morgan Stanley believe that later this year is when we will see perhaps a market top or, in my opinion, some definite issues in the stock market. And lastly, an analysis from Bank of America shows that stocks may already be losing their edge relative to treasuries. This past week, the 3-year treasury yield of 1.9% rose above the benchmark S&P 500's dividend yield of 1.89% for the first time since 2008. In other words, holding money in safe, cash-like assets like treasuries is now a competitive alternative to stocks for the first time since the great financial crisis. All of these factors would seem to suggest that repricing in stocks is on the way. At the very least, they should offer a wake-up call for equity investors who have become so accustomed to easy returns. So once again, raise your cash and subscribe to this channel. For today, that's ChewDog Charts. Thank you.